Hi students, welcome to the video on preparation of final accounts with adjustments at your fingertips. This is the second video, prepare on final accounts. So in this video, we will focus on adjustments. So you should know what is adjustment. While preparing trading and profit and loss accounts, an important point to be kept in mind that business is following accrual basis of accounting. That means all the income and expenses pertaining to one accounting period will be taken into account. All of you know that the financial year begins on 1st April of current year and ends on 31st March of the next year. So, expenses and incomes for the full trading or accounting period are to be taken into consideration. So, all outstanding and prepaid expenses, accrued and unexpired income means income received in advance, to be considered before determining the actual profit earned or loss suffered by the business. All of you know that this whole purpose of preparing income statement, that means trading account to ascertain the actual gross profit or gross loss of the business, then profit and loss account to ascertain the actual net profit or net loss of the business, and the positional statement or financial statement or balance sheet statement shows the correct financial position of the business. That means assets, liability, capital, so at its correct figure. So entries were passed at the end of the account period to make a record of the transaction omitted to be entered in the books. Suppose after preparing the trial balance, some items are not taken into account, that is known as adjustment entries. So entries are passed at the end of the accounting period to make a record of the transaction omitted to be entered in the books, or to set right the transaction which have been wrongly entered in the book. Wrongly entered means suppose treating the capital expenditure, revenue expenditure, capital expenditure, capital income as a revenue income, and vice versa is also wrongly entered in the books, and that is to be corrected with adjustment entries. Hence, before preparing final accounts, adjusting entries should be made to ensure that final accounts exhibits a true and fair view of the business. Then, what are the important adjustments? First is your closing stock. So, closing stock is given in the adjustment or outside the trial balance. Then it is having double side effect. Once again, you should remember whatever items given inside the trial balance, that will affect only one side, either on trading account or profit and loss account or balance sheet. But whatever items given in the adjustment, that means after the preparation of trial balance, is having double side effect. For example, closing stock. If closing stock is given inside the trial balance, it will be taken only on asset side as asset side of balance sheet. That means current assets. So that's current assets on the asset side of balance sheet. But it is given in the adjustment. So it is having double side effect. It will be taken on credit side of trading account by closing stock, and in the balance sheet asset side as closing stock under current assets. Then outstanding expenses means expenses due but not paid by the business. So it is a liability for the business. So what we have to do? We have to add the expenses, outstanding expenses and particular expenses on the debit side of trading account if it is wages or direct expenses, and profit and loss account if it is indirect expenses, for example salary outstanding. So in the particular expenses we have added the outstanding expenses and will show on the liability side of balance sheet. It will shown on the liability side of balance sheet. Then prepaid expenses means expenses not due paid in advance. So it will be deducted from the particular expenses on the debit side of profit and loss account. For example, rent prepaid. How much rent prepaid? That will be deducted from the rent on the debit side of profit and loss account. And these prepaid expenses, prepaid rent will be considered as current asset on the balance sheet asset side. Then accrued income, income due but not received by the business. It is an asset of the business. So in the particular income on the credit side of profit loss, it will be added and it will shown as assets in the balance sheet, that is current assets, accrued income. Then income received in advance or unexpired income. When income is received in advance, then we have to adjust in the future, so it is our liability. So we have to deduct that particular income on the credit side of profit and loss account and will show the unexpired income or income received in advance as liability in the balance sheet. Then depreciation on fixed asset. All of you know that depreciation means decrease in the value of assets due to wear and tear, means use. Then affliction of time means passage of time. Obsolescence means asset became outdated. So in case of depreciation on fixed asset, the journal entry is depreciation on particular fixed asset account debited to that particular fixed asset. That means in the profit or debit side, we write to depreciation on land and building, plant and machinery, furniture. Then in the balance sheet from respective fixed asset, the depreciation will be deducted. Then about bad debt. Bad debt may be new bad debt or an existing bad debt is inside the trial balance, then additional bad debt is written, additional bad debt written off. So in the debit side of profit and loss account, we have written to bad debt, then we'll add the further bad debt and we'll deduct that further bad debt from sundry debtor, the balance sheet asset side. Then provision for doubtful debt. What is provision for doubtful debt? Suppose at the end of the year, we are selling goods or business is selling goods on credit basis for a period of 3 months. Say on 10th March, it sold goods for 3 months. That means the 10th June will be due date. When 10th June will be due date, we will know how much is the bad debt. But we cannot wait till June. We have to complete our financial period on 31st March of that year. So based on the past experience, the business will keep some provision, maybe 5%, 6%, whatever, according to the business. So provision for bad debt account debited to sundry debtor. So in the bad debt, add further bad debt. We will also add provision for doubtful debt. Then in the balance sheet from sundry debtor, we have already deducted the new bad debt. Next, on remaining amount, we will calculate the percentage. Suppose sundry debtor is 61,000, bad debt written off now is 1,000. So it is 61,000 minus 1,000, 60,000 is there. We will keep 5% provision, means 3,000. So on the profit loss, bad debt, existing bad debt, whatever given in the trial balance will retain, add new bad debt or further bad debt, 1,000 will be added, add provision for bad and doubtful, 3,000 will be added. Then in the balance sheet, from sundry debtor, first we have written bad debt written of, new bad debt written of 1,000, 61,000 minus 1,000, 60,000, less provision for bad and doubtful debt, 3,000. 5% of 60,000, 3,000. So 57,000 is the good debt which will be shown in the asset side of balance sheet. Then reserve for discount on debtor. Sometimes as per the agreement, if the customer repay within the agreed period, suppose the business sold goods on 10th March for 3 months on credit basis and have the condition that if they pay within 1 month, then 5% discount will be allowed, but they have to pay within 3 months. So the customer, suppose the customer has repaid within a period of 1 month, 5% discount means 57,000 into 5%. So it is 57,000 into 5%. By 100. So amount is 2850. So 2850 we will show, or we will add to the discount on the profit and loss debit side. Or if discount is not there, discount allowed not there, we will add it with also the provision for doubtful debt. Bad debt, add further bad debt, add provision for doubtful debt, add reserve for discount on debtor. And that amount 2,850 will be deducted from good debt 57,000. That amount will be shown as sundry debtors. Then reserve for discount on creditor. Similarly, when the supplier, there is agreement between the supplier and the business that if the business repay within the stipulated period, the supplier will give 5% suppose discount. Suppose the goods worth is 1 lakh and the business pays within the agreed period, suppose it is 1 month, then the business will receive also 5,000 rupees as discount. So it will be shown on the credit side of profit and loss account as by reserve for discount on creditor. If discount received is there in the credit side of profit loss account, it will be added to discount received. That means on the credit side by discount received add reserve for discount on creditor. That discount will be deducted from sundry creditor on the liability side of balance sheet. This is all about 10 adjustment. We will discuss so many other adjustments. There are so many other adjustments that we will discuss now. So what are the adjustments we will discuss? See, adjustments, its effects. First effect, second effect. Okay. Then suppose it is given interest on capital. So 11th adjustment is interest on capital. So what we will do? It is having a double side break. Our journal entry is interest on capital account debited to capital account. So first effect is on the debit side of profit and loss account, we will write debit side of PL account. We will write to interest on capital. Then on the liability side, that is second effect is on liability side, we will add it to the capital. Capital is there, then you add interest on capital. This is the adjustment. Interest on capital. Then similarly, interest on drawing. When the proprietor withdraw cash, goods or asset for his personal use, it is known as drawing. It will be deducted from the capital. When the proprietor is receiving interest on his investment, similarly the business will also charge interest on drawing. It is income for the business. So on the credit side of profit and loss account, business will write by interest on drawing, and from capital it will be deducted. Capital less drawing less interest on drawing. Then another adjustment is there, interest on loan taken, same, it is just like capital. Interest on loan taken, it is an expenses, it should be shown on the loan taken. Business has taken loan from suppose bank. So generally it will be put on the debit side of profit loss account as interest on loan. Then on the liability side with loan, it will added plus interest on loan. So it is having double side effect. Then 14. Interest on investment given or loan given. So this is income for the business. Interest on investment given or loan given by the business. Loan given by business. So it is income by business. So it is income for the business. On the credit side of profit and loss account, credit side of profit and loss account, will write by interest on loan, by interest on investment. Then in the balance sheet asset side, this is credit side of profit loss, then balance sheet asset side, it will added either to investment, if investment is given, investment add interest on investment. If loan given is there, then it will be added, interest on loan will be added here. Then insured goods destroyed by fire. Insured goods may be insured or uninsured. If it is insured goods destroyed by fire, then insurance company will make good the loss. Destroyed by fire, then insurance company will make good the loss. So journal entry is always goods lost by fire. Initially goods lost by fire will be debited to purchase account. That means it will be deducted from trading account purchase. And goods lost by fire is the loss. It will be transferred to profit loss account if not insured. But it is insured. When it is insured, instead of goods lost by fire, we will debit insurance company. So insurance company debited to purchase. Suppose the loss is 10,000. So we write insurance company debited to purchase. If it is fully sanctioned by insurance company. If the loss is fully sanctioned, then partly sanctioned. Suppose partly sanctioned. So we have to see. Here from purchase it will be deducted trading account. Then insurance company we will write as asset in the balance sheet, current asset, that is balance sheet asset side. Then if it is partially sanctioned, that means out of loss of 10,000, insurance company will give only 6,000. So we will debit insurance company debited 6,000. Profit loss account debited. Profit and loss account debited hyphen lost by fire. The amount is 4,000 to purchase. That means we will deduct from trading account purchase 10,000. When we deduct 10,000 purchase, our gross profit will increase by 10,000. If gross profit is increased by 10,000, net profit also increase by 10,000. But 4,000 not admitted insurance company, it is law. It is shown on the debit side of profit loss account as lost by goods lost by fire, not admitted by insurance company. So when 10,000 was the profit, out of 10,000, 4,000 is adjusted now. So 6,000 is the profit left. It will be added to the capital. That 6,000 will be shown in the balance sheet asset side as insurance company 6,000. So it will tell you. Then when insurance company will make the payment, will write bank account debited to insurance company. Will receive suppose 6,000 here, bank account debited to insurance company. The amount will be, so deducted, insurance company will be closed and it will be added with the asset cash at bank 6,000. If it is fully insured, here insurance company debited purchase, and if it is settled, then bank account debited to insurance company. One journal entry here 10,000, 10,000. Okay. Then 16. Goods stolen. All of you know when goods stolen, same thing. Goods stolen. So we have to debit the profit and loss account hyphen goods stolen, then credit purchase account, or that means will debit deducted from purchase account or shown on the credit side of trading account. Both is correct. Either you show by goods stolen on the credit side of trading account, or you have to deduct from purchase account, that is trading account purchase. Then goods distributed as free sample. Goods distributed is free sample is just advertisement. So profit loss debit side write advertisement. Goods distributed as free sample. From purchase we will deduct the cost of goods given as free sample. Then in the profit loss debit side write to advertisements. Then goods withdrawn by the proprietor for personal use. Suppose it is on 18th adjustment. It is there. Goods distributed by goods taken by the goods distributed by business as free sample. 17. Goods distributed as free sample. So it is advertisement. So on the trading account from purchase we will deduct the goods amount or cost of goods. Then on the profit loss debit side we will write to advertisement. Then goods withdrawn by the proprietor for personal use. Goods withdrawn by proprietor for personal use. Then it is treated as drawing for personal use. So from purchase it will be deducted. From purchase the cost of goods withdrawn by proprietor personal use is deducted. Then in the balance sheet live side from capital we will deduct as drawing, less drawing. Then adjustment 19. On recorded purchases. Suppose on recorded purchase is there. That means it is not recorded. We purchase, it is not recorded. When we are purchasing, write purchase account debited to sundry creditor. That means add to purchase on trading account debit side. Add to purchase on trading account debit side. Then add to creditor on balance sheet liability side. Similarly, on recorded sales. Journal entry is sundry debtor account debited to sales. So add to sales on credit side of trading account. Then add to sundry debtors. Add to sundry debtors or total debtors on asset side of balance sheet. This is all about on account of purchase and sales. Then another 20. Capital expenditure included in revenue expenditure. That means capital expenditure treated as revenue, included means treated as revenue expenditure. So what we will do? From revenue expenditure and profit loss debit side, we will deduct it and we will add it to the balance sheet asset. Capital expenditure is our asset. So in the balance sheet, we will add to the asset. Then revenue expenditure is treated as capital expenditure. Reverse is the case. Revenue expenditure is treated as capital expenditure. We will add on the debit side of profit and loss account. Then we will deduct it from the assets. Then bills receivable disjourned. Bills receivable disjourned. So journal entry is sundry debtor account debited to bills receivable. Sundry debtors debited to bills receivable. So it will be on the both the account will be adjusted from balance sheet. So in balance sheet it will be added to sundry debtor and it will be deducted from bills receivable. Sundry debtor it will be added as bills receivable disjourned. In the bills receivable it will be subtracted. Then suppose bills payable disjourned. In case of bills payable disjourned, the journal entry is bills payable account debited to sundry creditors. To sundry creditors. So from bills payable the amount will be deducted. From sundry creditor the amount will be added. Then deferred expenses of advertisement. You know deferred advertisement means that suppose there is heavy advertisement expenditure of the business, it is treated as deferred advertisement expenses. For suppose it is 5 year given in the question, 5 year or 3 year, whatever that may be. So suppose the advertisement expenses is rupees 3 lakh. So every year from profit we will adjust 60,000. That means trading profit and loss account debit side. Profit and loss debit side will write to advertisement expenses written off. Advertisement expenses written off 60,000. Then in the balance sheet written off. Then 60,000. Then the balance sheet 3 lakh minus 60,000, that is 2,40,000 will be shown as deferred advertisement expenses not written off during the year. Then the revenue receipt suppose is included in the capital receipt. So from capital receipt we have to deduct the amount, and in the profit balance sheet capital receipt we will deduct the amount. In the profit loss debit side, profit loss revenue side we will include. Then last is commission before, after charging commission, before charging commission. Suppose it is in the question, it is very difficult. Commission before charging commission. Suppose commission before charging commission. That means you will show before charging commission. So you see how much is net profit before charging commission. Suppose it is 10%. Suppose net profit before charging commission is 1,10,000. So we will debit 10%. 10% means 11,000 as commission payable to manager. Suppose it is after charging commission. Commission after charging commission. Then we have to calculate like this, after charging commission. Then we have to calculate like this, that is commission 1,10,000 into, that is net profit before charging commission 1,10,000 into percentage of commission divided by 100 plus percentage of commission. That means 10 by 110. 1 by 11, that is 10,000. So net profit will be 1,10,000 minus 10,000, 1 lakh. 1 lakh. Here net profit 1,10,000 minus 11,000 is 99,000. Suppose it is before charging commission, the commission is 11,000 on 1,10,000. If it is after charging commission is 10,000, so net profit is 1 lakh. Thank you for watching the video. In the next video, we will adjust or discuss so many hidden adjustment along with some typical problem. Don't forget to like the video, share the video to all of your friends so that everybody will be benefited. Please subscribe if not already subscribed.